This week on April 2nd, it has been well telegraphed that we're supposed to receive this tariff day with more announcements and news around tariffs. We'll see, of course, what happens. But one specific way that people in the trading world can target such a sort of known unknown event, meaning we know the date of something happened, we don't know how markets are going to react, is by placing what's something called a straddle. In other words, where if the move is big enough, we can make money regardless of whether the market, let's say, goes up or down after that event. And so I was looking at the S&P 500, the SPY tracker ETF, and was looking at what a straddle would look like in this specific situation. Now, for a straddle, in order to understand how much a market is anticipated to move from the options market's point of view, is by taking essentially the most recent expiration. In this case, the weekly options expiration would be April 4th. That's where we start gauging what the move might be. And by adding the at-the-money call and at-the-money put premiums together. Right now, as I'm recording this here, that expected move is supposed to be about 14 points, 14 S&P 500 points. So basically, again, as I'm recording this here right now, that would essentially mean that the S&P 500 might move, roughly, let's call it, towards about 580 on the SPY 580 on the upside, and on the downside, it would be something like below 550. So 580 and 550. Now, it is quite possible in a situation like this that the market might move beyond that. And so if the market is going to move towards those extremes or even beyond that, I have a really good chance of making money. What I don't necessarily want is for the market to go nowhere, in which case I'm probably going to lose some money, but not a lot. And so typically speaking, when I do something like this, I like to use options that don't expire like this week or next week. Rather, I want to give it a bit of time, because if I'm wrong, if the S&P just stays flat, let's say, for example, or moves just a little bit in one direction or another, then typically I would be punished by implied volatility coming down and essentially ultimately time decay. But if I use options that expire, let's say, here in late March, early April, that I would expire, let's say, in May, right, monthly May options, and once I'm past that event on April 2nd, so maybe by April 3rd, the market will have reacted, I can then close it without having to be devastated from a bad loss in case the S&P didn't move, because there's still time value left in the options. So long story short, what we can do with a straddle in a situation like this, and I have to say I'm typically not a big fan of straddles, not that they're a bad strategy, but I think usually there are better probability trades to put on. But in this situation, essentially what we're betting on is, to give you a bit of a visual on this, is that the S&P 500 would move essentially beyond those 2 points you can see right there, or beyond the points of this box, right? So either above that box or below that box, or at least to the extremes of the box. So hopefully that's helpful, folks. See you in the next video.